Hey guys, John Polemy here, Actionable Intelligence. Today is Saturday, February 22nd, and this is the weekly market update. So, in this week's reality check, I want to talk about a speech given this previous week by one of the Federal Reserve governors. And in it, this particular Fed governor named Lael Brainerd, I can't pronounce her name, it doesn't really matter, said she favored a very aggressive policy approach to the next recession that would include capping interest rates beyond short-term rates, a policy known as yield curve control. Okay. Let's take a little bit of a look back to where we're at right now. If you go back a little bit over a year ago, or maybe 18 months ago, or 2 years ago, the Federal Reserve announced a policy that it was going to begin raising short-term rates to try to get what they called yield, or what they called normalization of interest rates, if you will. Interest rates had been taken down to very low levels and had stayed there for many years after the great financial crisis, as the Fed was trying to pump liquidity into the market and stimulate a wealth effect by having asset prices go up. They also had a huge balance sheet. Their balance sheet was around $4 trillion. They had been buying all kinds of mortgage-backed securities and things of this nature as a way to keep rates low and to stimulate housing, and all the things that go into housing. When you buy a house, carpets, everything's new, furniture, pots and all that stuff. So they finally realized, hey, look, we can't just keep this patient on these recovery dynamics forever. It's 10 years after the financial crisis and we still had record low interest rates. So they want to try to get some ammunition into their belt by raising rates so that when the next recession came, they would be able to cut rates. And they didn't make it very far. As you remember last quarter of last year, or 2018, we had basically a 20% decline in the stock market. Oil dropped massively in combination with the Trump double clutch on the Iran sanctions. And they were forced to back off. They were forced to back off on the balance sheet reductions also. And then we had this previous September, we've had the repo crisis, if you will. Liquidity was supposedly drying up in the repo markets. I'm just summarizing here. I'm not going to get too in depth into it. And so the Federal Reserve decided to go in and start buying hundreds of billions of dollars worth of Treasury securities. That's something they had not done in the past. They had been buying mortgage-backed securities and not so much short-term Treasury bills and notes. But this is what they were doing. That's known as high-powered money. The recent stock market bull surge, blow off top, if you will, pretty much coincides with the beginning of that high-powered money being injected into the system. So now we have a situation where these asset bubbles have gotten bigger. We have people coming out saying, we're never going to have recessions again. Stuff you see at the top, stuff that I would look at as being as a contrarian, that I'm seeing frenzy and froth. This is a new era. We're not going to have recessions again. The masters of the universe are controlling everything. And then you throw on top of this coronavirus situation, which is disrupting global supply chains, which is showing the chinks in the armor of globalization, if you will. We've had auto manufacturing shutting down in South Korea because they can't get parts. Foxconn in China is not producing iPhones, so Apple's falling behind on their sales, and yet the stock market's making new highs here in the U.S. Well, until last week, we saw some pullbacks. So people are asking, what is going on? And I've started talking about this really in depth as of last week. I've really seen the amount of traffic to these videos really go nuts all of a sudden, because I think people are shocked what's going on. They're looking for answers. And what we are seeing now, finally, is the culmination and the last act, if you will, in my view, of central planning via monetary control. You know, the Federal Reserve is not masters of the universe. They have PhDs, and I get all that, and they're very big on theories. And here we have another theory. You know, these people don't come out and say this stuff just on a whim. This is vetted. This is done deliberately. This is done in a manner to make sure that the groundwork is laid for policies that are going to happen. Now, it's very possible that right now the United States is in a manufacturing recession. I don't think the total economy is in a recession. We're certainly in a manufacturing recession. The data shows that. So they're prepping for the next recession. So look, where are we at now? Okay, we're sitting here and we have a Federal Reserve governor come out and say that they are going to manipulate the interest rate curve in the next recession. She goes on to say the Fed should also pledge to keep interest rates at zero until the Fed achieves its target of full employment and a 2% annual inflation rate. You know, we've talked about this before. Why does the Federal Reserve think inflation is good? 2% over a generation is 50% loss in your purchasing power over 25 years. The natural inclination of prices is to be in a slight disinflation. You want to know why people's wages have been falling behind and why people are not doing well? It's not just the trade policies that we've had, that's part of it, but it's this Federal Reserve that has been stealing through the insidious creation of money over time out of nothing, that has stolen via slight price increases, slight dissipation of people's wealth and purchasing power over time. You know, if you make $50,000 a year and prices are slowly going down by 0.5% or 1% per year, you're becoming wealthy. Your savings, your money that you're holding becomes worth more. Your savings become worth more. You're not forced to become a speculator because you can't just put money into like a savings bond or passbook savings account. I've told this story before. I remember when I was a kid, when they used to try to teach savings in elementary school, you would get those little red books and you'd put like a quarter in there or $1 a week or whatever. And I remember getting 5-6% on a passbook savings account. Now, if you're an oldster now, you know, you used to be able to put your money into CDs, get 4, 5, 6%. If you had, you know, a couple hundred grand, that would definitely supplement your Social Security such that you wouldn't be worrying about where your next meal or where your heart medication was coming from. But now we're in a zero interest rate world around the world because of all the debt. And now the United States Federal Reserve people are now prepping the people in the markets for the fact that the United States is getting ready to go to the zero bound. The next recession, whenever that is, we're going down to the zero bound. We're going to zero or close to it. And they can do that. They can, you know, Japanese central bank basically is the Japanese bond market. They basically monetize all of their Japanese debt. And they're basically telling you that's what's going to happen. Now, I think not the next year or two probably, but they will achieve 2% and way higher inflation. Why? How's it going to happen? Next time we have a recession, it'll be very bad probably. It'll be because there's so much misallocation of resources. We will get the typical Keynesian responses. Let's build a bunch of infrastructure. Let's spend all this money that we don't have. And they'll have to print it out of thin air. But when you print money out of thin air, your ability to do that is infinite. You can do that at any level that you want, or which you feel that you can politically get away with, because at some point you'll destroy the currency. But you can't produce copper, iron ore, cement, and oil, the things that you need to build that you're going to spend all that created money out of thin air on, cannot be created out of thin air. And therefore, if you throw more currency units at a fixed or slowly growing amount of products, the price of those products will go up. That's how you get inflation. I guess that's what the plan is. What's really working right now is that none of the money that's been created over time has made it into the real economy to be spent, because we've been in this austerity. with local and state governments, federal government not really, buying things like infrastructure, building things. Okay, what the created money has gone into is financial assets. That's why we're having these blow off tops. That's why, you can have the second largest economy in the world, China, basically in lockdown with its economy imploding. And we have a slide about that. We'll talk about some anecdotes. And we're making new all time highs over here. So it's not just the money creation, it's also capital flows. So let's go on and talk about, this, I talk about the Federal Reserve being the bastion of central planning equivalent to the old Goss plan folks in the Soviet Union. I've talked about Goss plan before. You should look it up on Wikipedia. It was this big, huge monolithic building in Moscow full of PhDs. I don't know how many stories it was. It took up several blocks. And they just sit in there and say, well, this is how many toothbrushes that we should make this year. And somehow, they were able to. I saw a documentary about this, and they went and interviewed these people. I think it was right after the Soviet Union collapsed. And they didn't even have computers, but with all these notebooks and chalkboards, doing all these calculations about how much shoe polish should be manufactured. Stupid. We look at that and laugh today. And they had the smartest people in the Soviet Union working on these issues. But they still couldn't make it work because you cannot central plan. Central planning doesn't work. It takes out the price mechanism. It takes out human action and preferences of a million different decisions that each human makes over a year's time. What type of toothbrush to buy, whether he even wants shoe polish, whether, whatever. If he prefers fried chicken to baked chicken. All these things are not taken into account by central planning. And yet, with one of the most important facets we talk about, which is interest rates, we leave it up to the masters of the universe, the Goss planners, the apparatchiks at the Federal Reserve, the masters of the universe, if you will, that we're supposed to bow down to. Remember Business Week after the 2000 tech wreck? Greenspan, the maestro, remember that? He was the maestro. I mean, this is ridiculous. If we had a committee sitting in government in some agency saying they were going to set the prices of canned peaches and light syrup, we would think it was ridiculous. It would be made fun of. John Stossel would be having a segment on his show about it, about how stupid it is. But yet, we think that these people can sit here and they know what the right level of inflation is, or the right level of interest rates, or the amount of money that should be in circulation. And all they do is create bubbles that burst and then create busts and misery. It's either at either extreme. These people do not know what they're doing, and they are creating a lot of the wealth inequality. I put myself in that thing. I've done well over the last 10 years. I have enough brains that I see what's going on and I could take advantage of it. Now, if you're even more closer to it, if you're one of the financiers on Wall Street, then you've made billions and your bonuses are in tens of millions and they're getting wealthier and wealthier. So, of course, you're seeing this resurgence or this desire for a piece of the pie and somebody like Bernie Sanders getting traction now because people feel left out. I'm getting a little bit off track here, but this is what's happening. People are not looking at these things. So under the yield curve policy, the Fed would target some long-term yield and tell the market that it would buy bonds to keep the yield from rising above target. So all you have to know to see this is that you should be, long-term bonds. You just front run the Fed. This is what all the Sharpies on Wall Street will do and are doing. The Fed's already told you what they're going to do. I'll get into why I think we're probably going to have some more interest rate cuts this year because the dollar is just going straight up, and that has a tendency to import disinflation into the economy. They just told you they want a 2% annual inflation rate. Well, you can't have that when the dollar is strengthening, and the dollar bulls are being proven right. Capital's pouring into this country because of the fear over the virus and the economic conditions and the possible economic bust that's going to take place around the world. And of course, some of that money goes into the U.S. stock market. That's why you're seeing all-time highs, uh, and this bubblicious environment. But our old friend gold's also doing well. Let's talk about that. Look at the dollar. This is just since February. I mean, basically, it's been strengthening quite a bit since this whole virus thing has taken off. Why? Because I know Peter Schiff wouldn't agree with this, but in the short term, and I don't trade short term. I'm not a trader. Okay. I'm not a trader. I look for long term, way I think things are going to be. I look for uh, when scenarios, not if scenarios. I look for undervaluation and try to buy that. I try to buy a dollar for less than a dollar. But you have to understand what's going on here. This is not positive if you're Donald Trump, if you're the Trump administration. Why? Well, when the dollar goes up like this, uh, exporters from the U.S. are harmed. Prices of U.S. made goods, base goods, go up for foreigners. This is also not good because of all the emerging market debt that's out there that's priced in dollars. When dollars appreciate, you have to come up with more. You have to come up with more of them. There's a shortage of them when they all pour into the U.S. How do you pay your debt? If your economy is based in local currency that's depreciating against the dollar, but yet you are forced to pay in U.S. dollars and this conversion rate goes up, well, certainly you can print more local currency, but that can create a problem too. This is not good. Let's put it this way. For the current way things are set up in the world, this is not positive. Now, we did see a big correction here, but that's just because the dollar is extremely overbought right now. Everybody's been pouring into it. It's doing what it has done in the past. It's a safe haven. People, when they get scared and the risk they want to get off risk, they go into U.S. dollars. And people would say, well, the U.S. dollar is going to eventually, yeah, I hear all that. But like I said before, it's the cleanest shirt in a dirty hamper. But look what gold's doing. If you don't understand that gold's in a bull market, then you're not paying attention. Gold is a currency also. Gold is acting as a safe haven asset also. Now you'll get the people on the Twitter sphere, different people will go. You try to walk into a 7-Eleven and buy a case of beer with a silver coin. You can't do it. No, but you can trade it in at a coin dealer and get dollars. You can go anywhere in the world and convert it to any currency. I can guarantee it. Gold is a currency. Gold cannot be printed. This is what you're really seeing. You're seeing, since it's the same thing, guys. It's like, since the repo thing started, this thing's been on a tear. And now you throw in the coronavirus scare, and it's acting as a safe haven. It's not typical for the US dollar and the gold price to rise together. It has happened in the past, typically in times when you have flights to safety like this, but typically they're usually diametrically opposed. When the dollar is going down, that's usually good for gold. Now, what I really follow for the price of gold long term is real interest rates, and that's the interest. That's the real interest rate is say the 10-year minus inflation. So, if you have a rate of 10-year treasury rate, say of 2%, and your inflation rate is 3%, then you have negative 1% interest rates. And negative interest rates are good for gold. Why? Well, one of the reasons is the opportunity cost of holding gold goes away when you have negative interest rates. People don't look at inflation a lot of times when they're taking into consideration returns. If you have 3, 4, 5, and then the trend of negative interest rates, the trend of rates is also important. Even if they're starting at a positive level, but they're trending down, and you have these dumb Federal Reserve governors making these stupid comments about how they're going to further undermine the value of the dollar over time and how they're going to lower rates and how they want more inflation. They're not going to be satisfied till they get it. I mean, is there any reason why gold's going up? They're just telling you what they're going to do. gold doesn't necessarily make you wealthy. It holds its value. I've said this before. It's a currency like yen, Swiss francs, euros, whatever, and it's one of the ones that cannot be debased, like they're debasing these paper currencies. It's another reason why Bitcoin seems to be kind of uh, gotten a little bit more strength recently. They can print infinite amounts of currency units, but men have to go into the earth and toil and dig gold out. It can't be increased as quickly, the supply. And that's why it's been a store of value for 5,000 years. And nothing changes. There's nothing new under the sun. I hate to say it. And we're seeing it now. Now, how you do get wealthy in a precious metals thing, this doesn't make you wealthy. This is just saying that this is holding its value or increasing its value in a speculative manner relative to the devaluation in the dollar. But how you do make money is with gold stocks, because typically gold stocks will react 3 times, 2, 3, 4 times what the price of gold does. And here's the GDX, the gold miners ETF, and you can see it's starting to move. There was a lot of lamenting the fact that the gold price was moving fairly significantly, and yet what were gold stocks doing? Now we've had quite a few. Some gold stocks have really moved quite a bit, but in general, the overall gold stocks have not been moving like we thought they would. But you can see now that in the last few days, this thing's really started to move, and you can start looking at specific charts of gold stocks, and they're starting to break out. There's going to be some laggards, but I can tell you this: I've already seen some earnings come through on some of these gold stocks that I like, that I watch, and I talked about it last week with one of them that I like in Zimbabwe, Caledonia Mining. I've owned it for a long time. It pays a nice dividend, increasing production, one of the probably the lowest cost producer on the continent of Africa. Yes, it's in Zimbabwe, but if you delve into what they're doing, things are just fine at the mine, regardless of what's going on in the country. And the stock is up like tremendously over the last few months because they came out and said, "Hey, look, this increased gold price, is really supercharging our earnings." That's a good thing about gold stocks. They have a lot of fixed cost in a mining operation. And once, say you're producing, 100,000 out, 200,000 ounces, let's just say 100,000 ounces a year, and your cost is all in is 1,500. Okay, well, you're breaking even at $1,500 an ounce gold. Let's just say that for example, and you're producing 100,000 ounces. Okay, well, you're making your payroll costs and everything, but then you go up by $50 and now you're making $500,000. And then you go up another $50 and now you're making $1 million. You just had 100% earnings increase. So you can see how once you are able to get above your fixed cost price at a mine, you can start showing tremendous earnings growth, and that will start attracting money. Like I've said before, it's all computers looking at things. They don't look at what this stupid governor said. They just look at the prices. Okay, well, look at the earnings on, Caledonia. Look at it's going up by 60, 70, 80, 90, 100% a year, and the gold price is going up. Buy. Or you get a change in the trend. If you have a trend following algo, gold stocks are now, breaking out. There's a bunch of people sitting around this week, and I can guarantee you, looking at the gold price at over $1,600 an ounce and looking at the fact that gold companies haven't kept up, there's a really good chance we're going to see some catch up here. And I think the gold price over the next several years is going to go tremendously higher. These central banks have no other option except for to print money. And the response to, one of the things I want to talk about before I get into these China slides later on is we don't know where this is going to end up. It just keeps growing. Now we've got I thought it was going to just be contained to China and was hoping for the spring higher temperatures to come and kind of kill the virus off. We've talked about how viruses and their membranes being gel, and they can't typically survive in higher temperatures. But we don't know what's going to happen. And now we've got it spilling out further and further. And if it starts grabbing hold, we don't know what's going to happen. But we do know that what the response is going to be to any slowdown in economic growth or any any, shall we say, big catastrophic moves down in any of these markets. These central banks are going to come in with all kinds of liquidity. So are we looking at a global recession? I don't know. We're looking at the data. Passenger car sales were down 92% year over year in the first half of February due to the virus outbreak. New apartment sales dropped 90% from the same period a year ago. There's rules in place that the CCP has said that you can't even be selling apartments now. They don't want people out looking around for apartments. But yet inflation's going up. Why? Because you've got the supply chains disrupted, but people still have to buy food and everything. And now you've got the consumer price index in China is up 5% annually in January, the highest in 8 years. It'd be tough to cut interest rates and not have further inflation if you already have it going. And I put this in here. Global supply chains are being affected. We don't know the full effect yet. So is it possible to have a global recession? Yes. Do I think the Federal Reserve is going to cut rates later this year? Yes. Going into an election year? Absolutely. We may not have seen the highs in the stock market yet. A couple comments on uranium I thought were great. I'll put a link to this in the show notes. You know, what am I doing? A lot of the things that we thought were going to get back because we thought with all the money printing, we would see a turnaround and a lot of these resource markets, which I think has now just been kind of interrupted by this whole virus. But I do think there's pockets of opportunity. I think uranium continues to be one. You know, you're not going to shut a reactor down because of the coronavirus. They're not going to stop building the reactors around the world that are being built. This is a long-term play, this chronic undersupply. And I think that, yeah, in general, if stock markets go down, I think these uranium stocks will go down, but I don't think you have much risk to the downside at where they're at. I mean, total market cap of the industry is about $8 billion. It's about as close to blown out as it can get. Can it go down further? It could. Do I think it will? No. Why? Because I think it's already turned around. We just don't have the data yet because the pricing is so opaque in this industry that we don't have the feedback yet, but that's coming. Why? Here's a little vignette. You got the Vimy CEO, Mike Young, was giving a talk recently. I think it was down in Australia. And he was talking about the contracting cycle and talking about how inventories have been worn down and talked about the lack of investment and just, all the things that we already know about as uranium speculators. And he said, he called it Groundhog Day. It's always on the verge of recovery, but never quite getting there. But he says that there's panic buying ahead from utilities as existing uranium inventories diminish, and they are going down. He said uranium is a long-term contract market. That's what we've said before. People that focus on the spot price are not looking at the right metric. But we don't have access to long-term contract prices. They're going to trickle out. They're usually signed with non-disclosure agreements, and we will not see those. Okay? Now, that news will slowly but surely make its way out, but it's not going to be done. Not going to see a press release from Cameco or Vimy or whoever and saying, yeah, we just signed a contract with Duke Energy to deliver 4 million pounds of uranium a year for the next 4 years at, $50 a pound or whatever. It's not going to happen like that. So after running down stockpiles for several years, utilities are contracting for delivery in 23, 24, and that's what they need to be doing. They need to be looking out and restocking their inventories, restocking that cycle. From mine to reactor usage is, anywhere from 18 months to 2 years. And if you're starting to get the message that there's, 10 players and only 8 or 9 chairs, it may behoove you to get your requirements locked in now, because I think that mindset, that perception, is starting to creep into the utility fuel buyer mindset. We're seeing it more and more discussed, and I think it's starting to seep into people's heads that the salad days of never-ending supply at $25 a pound are pretty much over. I thought this was interesting. This kind of matches up with some comments I heard Mike Elkin make on a podcast I believe it was with the Market Huddle guys, Kevin Muir and those guys. But he kind of mentioned the same thing, that there are contracts, and I think Cameco said the same thing. They are being approached. Deals are being discussed, and they will get consummated. And this is what Mike Young says. He says in 2019, 5 contracts were signed in the U.S. This week, there have been 4 requests for proposals from U.S. utilities. In 1 week, is that an anomaly or a beginning of a trend? We think it's the beginning of a trend, and so do I. This is what we've been waiting to hear. Now, this is just anecdotal. Some people might come back at me and say, hey, Mike Young's just talking his book. That's what Geitzel does. But at some point, guys, we know that there's not enough supply. We know supply is going down and demand's going up. At what point are you going to say that it's turned? The prices, are going to react before it's confirmed, unequivocally. That's the nature of speculation. Markets are forward looking. So this is one of the things I'm interested in, uranium. I like gold mining, certain gold mining shares, specifically royalty companies. They will do very nicely. They are doing very nicely. We have a royalty company in the Actionable Intelligence Alert newsletter that's up, 170% since we bought it. It's done tremendously well. Royalty companies are like just money minting machines when the commodity that they have royalties on are in uptrends. They're just terrific businesses. Very low capital, very low risk, and returns on invested capital are like margins are like 95% in the royalty business. You have like a half dozen people working in the home office, and you have there's really no overhead. Just wanted to revisit the WNA. There was a presentation about this whole thing about uranium supply demand, and I wanted to go down here and just I'll post this presentation. Most of you guys have probably seen this, but I'll post a link to it. You can go back and look at it. This is from like October, November last year. But there's plenty of uranium out there in the ground. There's plenty of resources. We're not going to run out of uranium. What is going to happen, and what is happening, is that there has not been sufficient investment to get that uranium out of the ground and get it into the python, have it go through that python. There's a big gap because of Fukushima. Fukushima, basically, because of what happened and because the producers produced into that oversupply because of the contracts they had, created this overabundance of uranium, drove the price down, and that kept the price signals from incentivizing replacement supply of uranium that was being mined. So then we've seen all of these shutdowns. Like I said before, you can go on WNN site and look up new nuclear, and every week you can see that new reactors are being put online. I mean, I think the UAE reactors, their big reactors are starting up now, or getting ready. One of them is getting ready to start up. And I just saw that Plant Vodal, they are talking about that project's going so well that they might defuel loading pretty soon and then have that thing online next year, which was earlier than anticipated. So the demand's there, it's increasing, it's being acknowledged by everyone that's increasing, and yet you don't hear any announcements of any new mines, mine expansions. All you hear about is cutting back, keeping things closed, not building new mines. Who's going to build a new mine if you can't make any money doing it? You have to have an incentive price, and it has to stay there for some period of time for people can get comfortable. You need an entire perception change to validate those decisions. And what is that price? $50, $60, $70 a pound? Who knows? And what about the regulatory environment? I mean, are you watching what's going on in Canada right now with these pipelines and this Trudeau government? Are you even going to be able to build any new mines there? Or if you do, what will be the time frame? Will it be 10 years? Will it be 15 years? And that doesn't, talk about Australia. There's a lot of resources in Australia. There's a big green movement there too. So that's why, you really need to kind of think these things out. I'm just saying, I think uranium is a place a guy could hide out during all this turmoil. And I'm not talking about buying juniors. I'm talking about buying quality. That means you buy a Cameco, you buy a Kazatomprom, or you know what the safest thing to do is? Just buy physical uranium, which can be done through uranium participation or yellow cake. You just got to watch the net asset values and make sure you're not overpaying. There's quite a few times when you can buy uranium participation at a discount to net asset value. And that's something people can do. You can hide out there. And then as this thing turns around, then you can start easing, lowering your physical holdings and move into the stocks. That's a strategy that people could do too. Or you can just sit there and cash. But at some point, I guess you have to make that mental decision. Is this market turning and am I going to participate in it? And when is that going to happen? And I think, what I've said before is you have to look for these when, not if events. And then you just got to position yourself. And like I said, I've just been adding regularly to these positions, especially I thought was significant what URA has done when they rejiggered their portfolio and knocked a lot of the juniors out of their holdings in the ETF to put Kazatomprom. It gave it an excellent opportunity to buy some good companies at cheap prices. So I think I don't talk a lot about uranium anymore because, to my mind, it's a done deal in my head what's going to happen. I don't know the timing of the turn or what the development of this bull market will look like, but it certainly seems to be we're seeing more and more anecdotal evidence, more and more vignettes that the fact remains that the contracting cycle that we were waiting for to drive term pricing is now here. Interest is increasing, and I think that will continue. So that's it for this week, guys. Appreciate the support, all the new people that are coming on board. I appreciate your, I don't know how, we surged by about 3 times in the last week with new subscribers or people watching this video. I don't know if people are passing this around or if it got picked up somewhere. Definitely welcome you on board. Encourage you to look at previous videos. Totally contrarian here and eclectic in our thinking. And we will continue to follow certain markets. Want to really encourage the new folks, take a look at the comment section, a lot of good information there. Follow us on Twitter at John Polemy. I follow a lot of smart people in these markets especially around gold and uranium. I think that if you're interested in those type things, getting involved in Twitter, you don't have to actually post, but being a lurker, you're going to be exposed to a lot of smart people that do a lot. I'm a generalist investor / speculator. I'm not an expert in any of these fields, but I am a generalist, and what I try to do is surround myself with the smartest people I can find, and then use their knowledge to benefit me. No one can sit around, as Charlie Munger says, and think it all up by himself. So that's it for this week, guys. A little bit long, but appreciate the support, and have a good week. We'll talk to you next Saturday.